Thank you for joining me. I'm Mitch Goldberg. We're going to talk a little bit about the bond market. We're going to talk a little bit about interest rates. The title of the show is Bye Bye 5% Savings Accounts. And there's a reason for that. Savers have actually finally been doing pretty good by keeping money in a savings account or CDs or other cash equivalents. And that is rapidly going away. The other thing we'll talk about, though, again, is for the bond market. I hear a lot of pundits, experts talking about alternatives to bonds. I want to say I don't believe there are alternatives to bonds. I think these are just polite ways and piss poor ways to say, let's go out on the risk curve to keep getting better interest rates or higher interest rates than what you could get in short-term instruments. And I think there's a lot of risk. I've seen this before. It happens every cycle. We'll talk about that risk, especially for those who are in retirement or facing retirement, but it should go for anybody. So let me roll the quick intro and I'll get into exactly what we're going to talk about. Here we go. All right. Thank you for joining me. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. I'm with Client First Strategy, wealth management firm, and we help clients get through all of the various life cycles and challenges that they meet financially. Plus, we have a really solid network of qualified professionals that could help you meet challenges, both planned and unexpected, in terms of so many areas of life, not just in finance, but we'll say from insurance matters to tax, estate planning, litigation of all kinds. If you need somebody, we have the right person. Even people in like HVAC, plumbing, home remodeling, we have connections because we spend a lot of our energy in networking because we know how important it is to have a network to bring to our clients. We bring a lot to the table in addition to our decades of financial experience. By the way, Client First Strategy next year we will be turning 20. I've been in the business for 34 years, but our 20th anniversary of Client First, I can't believe it. It's next year, and it's something I'm excited about. Bonds. Let's talk about bonds. The Fed's about to cut interest rates tomorrow. So this show is very timely. By the way, if you're watching this in the replay, because you're on my timeline, you follow us on Facebook or YouTube, thank you very much, and LinkedIn. So connect with me, by the way. If you don't mind, give the show a like. Follow us on Facebook, subscribe to me on YouTube. It all helps, and it all helps me get my message out. It's all educational, so it's a good message for you and your friends and family. So please do share the show, and I'd really appreciate that. It helps the show get bigger, and you'll be giving me feedback in terms of what you want to learn more about. So the bond yields, the 10-year yield, the 2-year yield, these have gone down a lot. It wasn't long ago that you were getting 5% in a 2-year treasury. And the yields have come down substantially, getting in the let's say high threes in the 2-year, and even the 1-year is below 5%. But what's happening is, as short-term bonds like 6-month, 3-month, 1-year, T-bills, and other short-term instruments, as they mature, your banker has to take your savings account that they invest the money into and reinvest in lower yielding securities, which means your yield on your savings accounts, high yield savings accounts, and 1-year CDs and 6-month CDs, that sort of thing, those are going to be going down, which means when they mature, you're going to be reinvesting that money into lower yielding securities. You're going to say, wait a minute, I was getting 50,000 on my $1 million savings account, and now I'm only getting 35,000, for example. That is a big deal for savers. It's tough to say exactly the timing of when interest rates go down that much, but the Fed is expected to begin its rate cutting cycle tomorrow. And at that point, we'll hear more from the Fed in terms of the Powell presser when the Jerome Powell, chairman of the Federal Reserve, speaks tomorrow before the press and gives us an indication of what to expect going forward. And the expectation basically is a quarter point. It's irrelevant if it's a quarter point or half a point. We expect, maybe markets expecting maybe 200 to 250 basis point rate cuts. So if the federal funds rate is 5.25 to 5.5, we're thinking a year from now it could be roughly 3%, maybe 3.25% in that range. That would bring mortgage rates down. All rates would go down. It's good for borrowers, bad for savers. That's the nature of savings. And lately, with inflation low, has come down a lot, and you're getting 5% in a savings account, you're beating the heck out of inflation. You're doing really, really good. But those really good times typically don't last forever. They get arbitraged away because if inflation goes down, then the high yield savings accounts will go down and follow inflation down because interest rates will follow inflation lower. All right, that's a mouthful. Now let's talk about proxies, replacements, bond replacements. I don't think there are any. And I know that's going to sound like anathema to say, but I don't like when other financial professionals say, well, you should go into dividend paying stocks, high dividend yield stocks, preferred stocks. Now, I'm not against those investments if it's the right circumstance, the right client, the right needs, all those important metrics. But, stocks are risky. And just because a stock has a dividend doesn't mean it won't go down. I think, and the reason I'm saying this, in my experience, in my decades of experience, when an investor wants yield and they want to get interest on something, they're looking for stability as well, that the value of their principal won't gyrate too much. And they're looking for an element of preservation of capital so they won't lose they won't lose money if the market goes down, if the stock market goes down. But you can't have those promises, those expectations when you invest in something that's not a bond. Now, bonds could go down in value while you're waiting for them to mature. You buy a 10-year bond today, over the next 10 years, it could go down in value. All you know is that at the end of 10 years, you're going to get your par value for the bond plus interest. That's all you know. What you don't know is the price of the bond from the minute you buy it until it matures. And you won't know everything in between. You just have to be able to wait. But stocks could go down. And I remember Verizon was a high price, pretty good stock to own a long time ago. AT&T was a good stock to own a long time ago. These stocks have gotten absolutely crushed in spite of dividends. And I remember a lot of boomers a couple of years ago who were looking for higher yields because interest rates were so low. They were crowding into dividend paying stocks, your typical blue chip dividend paying stocks. And a lot of those stocks got hammered. And a lot of boomers who couldn't really afford to lose money lost money, and they were either had to sell because they needed money to live on from their investments, or they felt pressured into selling because they were scared. And it's just not what they wanted. And now I see professionals making the same recommendation. Oh, you should buy dividend paying stocks or preferred stocks. I follow these closely. I follow preferred stock ETFs as well. And these things could have big ups, but they could have big downs, but they're not the steady Eddie type of investments, stable investments that is the other side of the same coin of interest, of yield. So buyer beware. And if you really need to if you need to squeeze more yield out of your portfolio, a lot of times you wind up going up the risk curve, which feels good in the moment, but now you're risking principal. So this is something for buyers to beware. As far as bond funds, bond exchange traded funds, because you're hearing a lot of other professionals talk about going to, going to a corporate bond ETF, or, you know, corporate high yield exchange traded fund, whatever. You know, we investors were buying bond ETFs a couple of years ago when interest rates were zero, and in spite of the stock market doing well, those bond funds are still down. And investors who bought bond funds when interest rates were zero or close to zero, I don't think they're in big losses now. I don't think they're ever going to recover from those losses, because if they're older, they don't have time to recover. They don't have enough runway. And B, unless interest rates go to zero again, I don't think you get those exchange traded fund prices again. And I don't think interest rates are going to zero. So beware. I prefer to own individual bonds with clients as opposed to exchange traded funds. I realize you get, a lot of diversification, but I like a maturity at the end of my bond holding. That's what I want. And I like to ladder my bonds, so some will mature in 3 months, some 6 months, some a year, some 2 years. This way I've always got something maturing to reinvest, which could be in a lower yield or a higher yield. That's the risk I'm taking. But it's better than locking everything up now, just in case yields do go higher and I'm locked up and I have no more money to invest. But I take the chance that yields could also go lower. It's a compromise. It's called diversifying your bond maturities. Diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. So good luck, savers. But unfortunately, the good times are coming to an end. I'm not saying that savings account yields are going to plummet tomorrow, but they are on a pretty quick glide path to go lower. And this is why we say that you should not just have all your money into short-term instruments, savings accounts, T-bills, that sort of thing, cash equivalents, because you're taking that reinvestment risk of in reinvesting into lower yielding securities. If you want higher yielding securities, you're going to have to take higher risk. And it sounds good. Oh, you get more yield this way, but you have to look at the risk side of the equation and understand if you're comfortable with loss of principal, and how comfortable are you with loss of principal. And I think this is where a lot of people make mistakes, especially, again, I hate to pick on you boomers, but those are the people who are most desperate for higher yield. And typically they've shown a willingness to take on more risk. And they've also shown periods of regret. All right. So that's what we have to know, but it's not bad. It's just you need to know yourself. Let's take a quick gander at the market. The Dow, after hitting a record high earlier today, look, it's right at record high. So if it goes up at all, it's going to hit a new record, right? But down 16 points, which is nothing. NASDAQ up 35 points, not a whole hell of a lot. S&P did hit record territory before, but basically closed flat on the day. Gold is still, almost 2,600 the ounce. Oil 71, so it's back to over 70. But it's if belief in a recession story, hard landing story comes into the fore, oil goes down. If you don't think the economy is going to crash, oil starts to go back up. Retail sales figures today were pretty strong, better than expected, which is another reason why I expect the Fed to cut only a quarter point. Remember, the Fed could always step up their interest rate cuts to 0.5% if they feel they need to. I just don't think they feel they need to do it now. And that's why I'm still looking for a quarter of a percentage point. 10-year yield, 3.67%. VIX at 17. It's come down a lot, but a lot higher than that, 12, 13 level that we've been accustomed to. Anyway, that's it for the show. Thank you for watching. If you have any questions about your investments, about what you're doing for yield, dividends, saving for specific goals, retirement, college savings, all that, you know who to call. All right, give us a call. We would love to help you. And we are always up for a no obligation consultation. All right, see you soon. Thanks. Bye.